Hi, I'm Mike Swanson, speaking to you from Music City, Nashville, Tennessee, here at the headquarters of Advocate Capital. And this webinar today is brought to you by Advocate Capital. And I'm going to be joined today by a special guest. Our topic today is choosing the right retirement plan for your law firm. And so I've asked Dane Cooper to join us. And Dane, are you there?
How about now?
Looks great. Fantastic. Well, Dane, thanks so much for joining us today. We appreciate it.
Yeah, happy to be here.
Fantastic. So before we get started, I'm going to use one of our normal disclaimers. So this webinar has been prepared for informational purposes only and is not intended to provide specific tax, legal, accounting advice. You should consult with your own tax, legal, and accounting advisors before taking any actions based upon this. But you might want to share this with one of your advisors and begin asking questions. So if you've tuned in today, you may be thinking about retirement eventually or developing a plan for your law firm. Your presenters today will be myself. I'm the president and CEO of Advocate Capital. We have coming up on about 500 plaintiff law firm clients around the nation, and we do get asked from time to time, how do I retire from the plaintiff law firm business? I'm also the author of How David Beats Goliath. It's the only finance training book for plaintiff lawyers. And if you would like a copy of that, message me afterwards, send me an email. I'd be happy to send you a copy of that book. But today's featured guest is Dane Cooper. And Dane is a financial advisor with Capstone Financial. And Dane, welcome again. And can you tell us a little bit about Capstone and the kind of work that you do for your clients?
Yeah, absolutely. So Capstone Financial is a full-service financial planning firm. We are located in Atlanta, Georgia. Okay. Our firm has about 80 advisors, and we have the ability to specialize in a variety of areas. Most of my work is done on the individual or family basis and small business. So I do a lot of work with clients to help them retire, get their kids through college, achieve other financial goals. Maybe that's estate planning or how to minimize taxes along the lines of their finances, or help their businesses get different types of benefits for their employees. Maybe that is a retirement plan, obviously, or other group benefits, health insurance, life insurance, disability insurance.
Right. Well, I know you've been very helpful with quite a few of our clients. We've heard some good things. You've been helping us out specifically in the areas of life insurance and other areas. And so once again, we thank you for joining us today. We do get asked, Dane, about retirement. It's a difficult question. You know, how do you sell your law firm? How do you retire someday? So we wanted to create this content for not just Advocate's clients, but all plaintiff lawyers out there who hopefully are starting to think ahead and plan about that. And what I'm going to try to do now here is to give Dane the control here. Hang on. Okay, and make presenter. Okay, so Dane, I should be handing off to you if you want to share your screen. We'll get started with that. So, you know, while you're doing that, I guess, you know, why would you want to have, oh, there it is, great. Why would you want to have a retirement plan at your law firm? Why is that something a lawyer should think about?
Well, for several reasons, and so we'll go ahead and get and dive into it. As many of you in the audience are probably aware, any good company is going to have good benefits for their employees, and having a retirement plan is probably at the top of that list. So today we're going to talk about having a retirement plan, or you may have heard it called qualified plan, which qualified plan just means that a retirement plan meets certain IRS guidelines and therefore receives tax benefits. Those are the incentives to get individuals to save for their employees. The IRS is going to give you some benefits or breaks on regular tax obligations you would have had otherwise. So kind of why have a retirement plan? Well, it helps people build and save for their retirement. It's a need that everybody has. And as I just mentioned, you get tax savings on your taxes, either on the contributions you put into them or the withdrawals you take out of a retirement plan. You can have certain tax privileges and our tax breaks, and we'll get more into detail on those in a little bit. And so that, dovetails into number two, it reduces taxes for the participants, but specifically for the business owner, they're going to have matching obligations depending on the type of retirement plan they choose. And all of those matching contributions for their employers are going to be dollar for dollar tax deductible too. So something that's a nice result for their employees is the employer can kind of decide, hey, do I want to give this money to Uncle Sam, or do I want to give it to my employees? And that dovetails into number 3. So it's going to help you, the business owner, if you own a law firm and have employees, it's going to help you, number 1, attract better employees when you're hiring, whether that's associate attorneys or other staff. And then you want to make sure you hold on to the good ones. And having a great retirement plan at your law firm is going to be a very good way to help retain those good employees and stay with you for a long time.
I can tell you from experience, Dane, we're here in Nashville, Tennessee, a very hot market, much like Atlanta is in terms of employment. And we think that, having our 401k here at Advocate Capital, we get feedback from our employees that it's one of the big issues for them long term. And we also have to compete with much larger companies. We have about 45 employees. We're competing with very large entities here in town. And now I think a 401k or something like that is just expected to be able to compete.
Yes, it really is. And some history behind it is the type of qualified retirement plan. Is it a defined benefit plan or defined contribution plan? The old standard industry-wide in the economy at big employers was to have a defined benefit plan. And the difference between the two is when is the promise made? So a defined benefit plan is like a pension. Everybody used to have pensions a long time ago, but that's not the case. Now employers offer defined contribution plans, and that says we're gonna make a promise to you today, and we're gonna help fund your retirement. And they're not promising the pension defined benefits on the back end like they used to.
Got it.
So today, what we're going to do is look at defined contribution plans. Like I said, defined benefit plans are more and more going away, and employers, to relieve their back-end obligation, are doing the defined contribution plans, which is exactly what a 401k is. So today, we're going to look at the differences between a 401k plan, a SEP IRA, or simplified employee pension, or what's called a simple IRA, which is a savings incentive match plan for employees.
Okay.
These are probably the 3 most common retirement plans that are implemented. I would say regardless of the size of the company. Typically the 401k is going to be the most common. It is the most popular. It's probably the one you folks have heard of the most. We're going to be discussing 2 different variants of the 401k, the safe harbor and the solo. But in terms of describing each of them, we're going to start with the the SEP IRA first.
Okay.
So the SEP IRA is a very simple plan. It is designed or most effective for the solo attorneys out there.
Okay.
Who haven't quite yet hired much staff or don't have staff at all.
Okay.
So when you open up a SEP IRA, and any individual business owner can do so, you can contribute 25% of your pre-tax income into the IRA account, up to $55,000 a year. So you can
that's a big number.
Really contribute a lot into that account.
Yeah. And
that $55,000 is then taken off your taxable income for that year. So you can reduce your tax obligation by about $20,000 to $30,000 depending on the tax bracket that you're in.
Wow, that's huge.
Yeah, it's a big chunk. So in terms of who contributes the money into the plan, it's 100% employer funded, but that makes sense because the business owner is the only employee is the employer. He's the only person in the company.
Sure.
Now, if you do have employees that work for you, the SEP IRA can still work, but whatever percentage of your contribution you put in your SEP IRA, you have to contribute a proportional amount to your employees' SEP IRAs as well. So that means they open a SEP IRA, you mail a check and deposit it into the account, and whatever, if you're doing 20%, you got to do 20% of their salary for each person every year. So if you have multiple employees, that can add up and be very expensive. So therefore, the SEP IRA is not ideal for multiple employee situations.
Okay, yeah.
So the maximum contribution for the SEP IRA is the $55,000. What's great for the SEP IRA in terms of deadlines to establish is October 1st. Now, that October 1st, we'll use this year for example, you can open up a SEP IRA before October 1st and contribute to it, and you get to count those contributions towards the previous year's taxes if you so desire.
Okay, so we're in 2018. Someone could wait until September of 2018, open up a SEP IRA and fund it, and that contribution would come off of 2017's taxes.
That is correct.
Wow, that's a long deadline.
It is. So that is very attractive. The flexibility really helps a lot of sole proprietors manage their tax obligations for the previous year by deciding how much they want to contribute to their SEP IRA the year after. So they can really leverage that flexibility.
Yeah.
Investment decisions are made, by the business owner who set up their own SEP IRA. Typically, it's going to be mutual funds that I recommend clients invest in, but they could, a SEP IRA, you can invest the money in whatever you want, individual stocks, bonds, mutual funds. Usually mutual funds is a great fit. Now, there are IRS tax guidelines and privileges you get for using these plans. So there is testing that's done to make sure the matching is fair. Again, that's the 25 or the proportional rule. So as long as you're contributing a proportional amount to your employees, if you have employees, then you're going to meet testing requirements. One of the deficiencies of the SEP IRA or any IRA platform is that loans are not available. We'll get more into that later. And there is no Roth option with the SEP IRA. You can only make a pre-tax contribution into a SEP IRA. There are no Roth contributions to a SEP IRA.
And would now be a good time to talk about Roth, or you want to come back to that?
We'll come back to that.
Okay.
But it is a very important question.
Yeah.
Okay, so those are the dynamics for the SEP IRA. The main ones being you can get $55,000 in there as long as it's not more than 25% of your income. And you have great flexibility to make contributions even after the tax year. You can do it in the following year and still count it towards the previous year's tax.
Yeah, sounds like it could be a great solution for a solo.
It is. It is fantastic. You're absolutely right, Mike. Okay, so now we're going to go to the 401k. There are two versions we're going to talk about today. Safe harbor, assume that's if you have employees, or solo if you don't have employees. Oh, and one other actually major detail with the SEP IRA. If you open a SEP IRA and you do have employees, you can start contributing for employees whenever you want, you have to contribute for your employees that have worked for you 3 out of the last 5 years. So if you have a SEP IRA and you decided to hire your first person, you do not have to immediately start contributing for that employee until they worked for you for 3 years. So that is a very important detail as well.
So it wouldn't necessarily cause you to not want to hire somebody. You can deal with that over the next 2 or 3 years.
Yes, yes.
Great, good to know.
Okay, so back to the 401k. Safe harbor, assuming you do have employees. Solo, you can set up a solo 401k. You're the only employee for your company. You may want to do the solo 401k as opposed to the SEP IRA, and that's due to the structure of the contributions. So you can see the contributions are a little different here from the SEP IRA.
Yeah.
Any individual employee, anybody who works for the company themselves can contribute $18,500 in a given year, and that's the amount for 2018. Now, if you're 50 years old or older, you can contribute an additional $6,000 into your 401k as a catch-up provision.
Okay.
And
so is that to kind of allow folks who are later in the game to maybe speed up their contributions since they're getting close to retirement?
Yes, that's exactly right. The IRS wants to see, the federal government wants to see people retire successfully. So for people that are 50,000, they'll give them extra room to contribute that money into their 401k, and they can do that on a pre-tax basis or a Roth basis. And again, we'll get to the pre-tax versus Roth in a minute.
Okay.
But that is a provision. Now, if you do have employees, you have matching obligations just like you did with the SEP IRA, but they are different. With now, the reason I'm using the safe harbor example is because that helps all tests get met, meaning you stay within IRS guidelines automatically by nature of these matching guidelines to meet their requirements of a qualified 401k plan. So those guidelines are as follows. You can contribute 3% of everybody's income into their 401k, whether they participate or not. So that's choice 1. Or choice 2 is to contribute 4% for anybody who maxes out their contributes to their 401k. Okay. So you can choose everybody, or if you think not everybody's going to contribute, it may be a better play to do 4% for those people who contribute.
Yeah, good point. Okay. So now, there's a 100% match on the first 4% that they put in of their income. So if they're just using an easy number, their comp is 100,000, they put in 4,000, the match is another 4,000?
That is correct.
Okay, great.
Yeah, dollar for dollar match up to 4%.
Yeah, good deal for the employee. It's an instant 100% return on the money.
Yes, it is.
Yeah.
And there is, for both the SEP IRA and the Safe Harbor 401k, there is no vesting. You may have heard of that term before, vesting, meaning the employee has to wait a couple of years before the money is actually theirs, even though it's in the account. There is no vesting with either the SEP IRA or Safe Harbor 401k, so the money is theirs immediately.
So if the employee resigns or is terminated, that's their money, they take it with them?
They can, yes.
Got it.
And then there is profit sharing that's available under the 401k plan. So if the business owner, the company has a great year, the business owner can decide to share additional profits in the 401k plan. There are proportion requirements to do so, but it is in favor of the business owner. So that person can contribute more profit and defer more income into their 401k dollar for dollar versus employees, which is what makes it attractive. But that option is available for the business owner to decide on year to year.
Okay.
So if the company had a great year, they can profit share into the 401k if they want to, which helps demonstrate the maximum of the 401k per participant. So no one participant, including the business owner, can get more than $55,000 into their 401k in a given year, or $61,000 with that catch-up provision.
But that would require a profit sharing provision to get to that high number, right?
That is exactly right, Mike. So if you think about it, the employee does $18,000 with their 4%, maybe that gets them to another $24,000, and then it would be profit sharing above the $24,000 or so to maximize at the $55,000 number. The maximum income the IRS allows for matching purposes is $250,000. So if you make $1 million a year, you can't do a 4% match and get $40,000 in there. The matching max income is $250,000.
Okay, 250.
Now, the reason I mentioned the solo 401k as opposed to SEP IRA for individual business owners who are the only employees is that they may want to do the solo 401k because they can get that same $55,000 in here because there is no percentage of salary requirement with the 401k. So if they make less than $250,000, they can still get $55,000 in there, even though they make less.
And they would do that as a combination of the individual contributions of $18,500, maybe plus a catch up, and then the rest again would be profit sharing.
Exactly, it would be a mixture of those three.
Interesting. So that would be, you wouldn't have that 25% of salary cap.
Right. Maybe that's 35%. Maybe it's 40%.
Yeah.
With leveraging the solo 401k.
Mm-hmm.
And solo 401ks are about just as easy as SEP IRAs to open. You basically just open the account and invest the money, and that's it. Because you're the only employee, there's really no administration or testing requirements that come along with having employees.
Mm-hmm.
So moving on, deadline to establish October 1st. Now the difference with the 401k versus the IRA is that it is October 1st of this year. So if you want to have a 401k for 2018 income, you have to have it set up by October 1st of 2018. If you try to set it up in November and make all your contributions, it will not count for 2018. It'll have to count for 2019.
Oh, that's an important difference between that and the SEP IRA.
It is, yes, very important.
Great.
Again, the participant makes all the investment decisions in the 401k. If you have employees, typically you're going to have a menu of investments to choose from, and that is the criteria they make the selection around. They cannot take the money and invest it in whatever they want. There are going to be different, usually panel of mutual fund choices that they can choose from. And it is important to know that the employer has to do their due diligence to make sure the menu is a quality menu of investment choices, but that is my job to help the business owner accomplish, and we can work with the 401k provider to make sure all the mutual fund choices are appropriate and not too risky. And that's not difficult to accomplish at all. Because we are doing the safe harbor provision, we're gonna meet all matching requirements of the IRS, and that will not be a problem. Another difference with the 401k is that participant loans are available. So financial hardships, illness, or the purchase of a home are all examples of common loan provisions within a 401k. The business owner of the company who sets up the 401k is able to make decisions around what's qualified reason for a loan. They can define that within the plan. Typically, those are the three that are selected to give employees that flexibility if they should need to, access the money before they retire.
So they can borrow money out.
That is exactly right. If they choose to do so, there is a stated interest rate on the loan, and the money, the loan principal they pay back plus the interest, it actually all goes back into your 401k. So you're technically paying yourself the interest while the money is outstanding. So that's a great privilege to have as a financial advisor. I'm going to try to help my clients avoid doing so, but the money is there for them if they did need it.
Yeah, that makes sense. What is the interest rate? Does that change from time to time?
I believe that is also a choice of the business owner when they define the plan, but that's probably based on current interest rates as well.
Yeah. Okay.
And now the 401k is different from the IRA because the Roth provision is available. So you may have heard of pre-tax, a Roth versus Roth or a Roth IRA.
Yeah.
All the Roth means is that the tax privilege comes on the back end instead of the front end like it does with the pre-tax. So when you contribute to a SEP IRA or a 401k on a pre-tax basis, that means whatever you contribute is removed from your taxable income when it comes time to settle up with the IRS. So they will not count it as income, and they won't tax you on that money. So you get the money into the account without having had paid any income taxes on the money that you were paid.
Right.
The money then grows inside of the 401k tax deferred. There are no taxes year to year as that account grows. But when you go to pull the money out in retirement and you've made pre-tax contributions, that is when you're going to be paying your income taxes to the IRS. Roth is the opposite. So Roth says, you know what, IRS, I'm going to pay you today. I'm going to pay you your income taxes. The money then goes into your 401k account and again grows without any tax obligation every year. And then come retirement time, when you have Roth contributions, you're able to pull out the money and pay zero taxes. So that's when you get to enjoy your tax benefit with Roth. So you get to choose. Go ahead, Mike.
Yeah, so you get to choose when you're going to pay the taxes, either on the way in or on the way out. So,
yes.
What are some considerations people would think about when trying to make that determination? I mean, who knows what tax rates will be, when they retire? How do you think that through?
It's a great question that has a lot of dynamics to think about. A lot of supporting arguments either way. And people ask me that question. At the end of the day, my opinion is it's better to do Roth. People try to take into consideration, well, tax brackets, this and that. Most people prefer pre-tax just because they get the break today. They want to go ahead and get their break on the taxes. As a financial planner, I really like the idea of people being able to look at their retirement account and know that 100% of the money in that balance is theirs, as opposed to 70 cents on the dollar.
Right.
So a lot of people think, you know what, I've got $1 million in my 401k, I'm doing great. Well, no, you don't. You really have 700,000. You don't have $1 million.
Because those taxes they're going to have to pay to get that out.
Yeah, they're going to be paying taxes when they pull the money out. And, people like to defer today because they have to pay less taxes. And, when you think about it, okay, you're saving more money today. What are you doing with that money to help improve your future? Well, probably most people are not going to take the difference that they've saved and put it somewhere. They're probably going to spend it And 30 years from now, are they going to really remember what they spent it on and be glad that they did it? Or are they 30 years from now going to be really glad that 100% of their money is theirs, not 70 cents on the dollar?
Very interesting. I hadn't thought about it that way. Yeah, that makes sense.
So there are a lot of different ways to think about it, but it is the employee's choice, and they set it up. When they go to when they set up their 401k account, they're able to manage whether they want to do pre-tax or Roth, and it can be changed at any time.
That's what I was going to ask you next is, can it be some of this and some Roth and some non-Roth? And how often can you change it? How do you do that?
Yeah, you've got full flexibility. You can adjust the contribution at any time. You can do half and half. You can do percentages. It's very, very flexible and user-friendly. Something else to consider, any match that you get in your 401k from your employer is going to be pre-tax, regardless of whether you choose to do pre-tax or Roth. So at best, you're still going to have pre-tax money in your 401k even if you were a big fan of the Roth, and that's because your employer is contributing that money in there for you, and they're writing it off their taxes. So the IRS is not going to allow this money to be after tax in the account.
So even if you choose the Roth option, the portion that your employer contributed, when it comes back out later in retirement, that will be taxable.
That is exactly right.
I see. Okay, that makes sense. Yeah. Wow. Good points. Okay.
Okay, so those are the two main ones, the 401k and the SEP IRA. And, honestly, the simple IRA is another plan platform that exists. I'm not going to get into to a ton of detail or spend a lot of time on it, actually, just because it's a smaller plan platform. The matching is less. I don't like it because the business owner can only get 12,500 plus 3,000 into it, plus the matching. I mean, they can get 23 in there in a given year, but it does not come anywhere close to what you can do with a SEP IRA or a 401k.
Right.
So I'm not a big fan of this simple IRA. It's got a lot of moving parts, and the opportunity is not as strong with the simple IRA, so we don't have to spend a lot of time talking about this one as well. Any differences are here on the top half of the page, where you can see the employee can't get as much in, nor can you get as much in with the catch-up provision. There are smaller matching components and a lower cap in a given year. Because it is an IRA, it's similar to the SEP. You can start it and have money count towards the previous year's taxes, and there is no loan option and no Roth option.
Wow, yeah, it doesn't sound that attractive, really.
No, and a great example here is in this little spreadsheet, where you can, as a business owner, see the bottom line advantage to one, having a retirement plan, and then seeing what the real life effects would be if you had a simple IRA or if you had a 401k. So here we've got my buddy Mike Z, not my guest, Mike Z.
It's a nice guitar, though. Is that a Guild, I think? Nice.
I guess so. Is that a Spanish guitar? But I'm not exactly sure.
That's all right.
So here we can see Mike Z's the business owner. He pays himself $250,000 a year. He's got Jimmy, Eric, and Carlos that are his employees. Jimmy Page makes 50, Jimi Hendrix makes 45,000, Eric makes 40,000, and Carlos makes 35,000. These guys all contribute to their simple IRA. Carlos decides not to, therefore he gets no match. Mike gets to match himself $7,500 on the $15,500 he contributed, and then he matches Jimmy, and Eric on their contributions as well. So basically the check annually that Mike stroked to their accounts totals just under $4,000, which is taken off of Mike's taxable income for the year because he wrote that check into his employees' accounts. And then Mike also deducts another $23,000 between his $7,500 match for himself and the $15,500 that he contributed to his simple IRA. So he was able to reduce his taxable income by almost $27,000 by contributing to these accounts, $23,000 of which he kept for himself because it went into his own IRA account.
Right. Plus, he gets a tax benefit of let's call it a third of 30. Probably saved another $10,000 in taxes.
Exactly. So that's a huge benefit for Mike and a huge benefit for his employees.
Sure.
They get to start saving for their own retirement. They get a couple extra bucks from Mike, and they really like working at the guitar shop even more because they've got this great retirement plan. And now, if Mike chose to do the 401k, we can see the advantages that the 401k provides by offering higher limits. So now, because Mike is over 50, he can contribute $24,000 on a pre-tax basis into his own 401k. Jimmy, and Eric all contribute the same amount into their 401ks as they did with the simple IRA. Because it's a 4% match, Mike is going to be putting in just an additional $1,000 is the only difference. Wow. In terms of money he has to give to other people. But then he's able to match himself a higher amount too, and now he's able to contribute $34,000 into his own 401k account. That is on a pre-tax basis in this example, and he's able to reduce his taxable income by the 34 plus, we'll call it the other $5,000. So, he's close to, $17,000 in money he would have paid to the IRS.
And now he only had to pay $4,800 to get that.
Correct.
Wow, huge tax saving.
Between the difference of the simple IRA and the 401k, with just an additional $950 contribution on an annual basis he made on his employees' behalf, he was able to get $11,000 more into his 401k account because it was a 401k, and not have to give additional money to the IRS. He was able to keep it for himself.
Yeah, powerful example. Great. Okay, what's next?
So that is the power of these plans, and to get started on them as soon as possible is ideal. You can see, if you start contributing at a younger age, the money you have in retirement is going to be a lot higher than it was when you started. If you wait and defer, you're losing this end of the graph the longer you wait to start for retirement. So there's no better time to start contributing for retirement than now.
Yeah, I didn't really realize a sole practitioner, a solo, could do the 401k. That's really eye-opening for me.
Yes, yeah, it's a great opportunity and very easy to set up.
Yeah, great. Okay, well, do you have any other slides you want to share today, Dane, or do you want to throw back to me maybe?
Yeah, I'll share it back to send it back to you.
Sounds good. And then we'll wrap up. We are going to open the floor up for some questions now. I have a couple questions just as I was watching this. And one of them is if you were to start out with the SEP IRA and then you start hiring employees, can you switch? How does that work?
Yeah, the answer is yes, and it is a simple process. You would open up a 401k as you would even if you did not have the SEP. Okay. The 401k allows for transfers in, so all that matters is that you don't take the money out of your SEP IRA yourself. You have your SEP provider just take the balance of the money and send it to your new 401k provider, and the money goes directly from account to account. And it's very easy to do,
Okay.
and there aren't penalties for doing so.
So you could switch administrating if you start to ramp up, start hiring employees, you want to take advantage of the 401k and that kind of thing. What about administrative costs, Dane? Are there appreciable differences between, let's say, the SEP IRA and the 401k in terms of what it's going to cost to actually implement it?
You know, they are negligible. The
Okay.
SEP IRA has no administrative costs. The 401k, when you have employees, it does. There are some startup costs to starting the plan and having it administered. Typically, if you have employees, I'm going to recommend you use a third-party administrator to stay on top of your IRS filing requirements year to year. Right. It's about $1,000, maybe a little bit over, to start a 401k
Okay.
and get it up and running, payroll deducted, working with the TPA. But after that, there are small costs year to year, and it's absolutely worth every penny.
Okay, let's see. And we have another question here. What happens if an employee leaves my company? I think we kind of touched on that. SEP IRA and 401k, are they the same? And what happens if they leave the company?
Yeah, if they leave the company, it's not a big deal. The employee has 3 options, and there are no obligations on part of the employer. The money stays in the account. It's going to stay there until the employee chooses to do something with it. So employers don't have to worry about it. If for some reason an employee was to leave, the employee can leave the money in the plan. They can move it to their new employer's plan, or they can move it to a personal rollover IRA.
Great. So they move it to another employer's plan. That's great flexibility for the employee.
It is.
Fantastic. Great. I don't see any other questions, so we're going to recap with our disclaimer. This is not meant to be specific information you should take action on. Be sure to hire your own independent financial advisor, although Dane is an excellent choice if you're thinking about that. So if you wanted to get a hold of Dane, his email is on the screen along with his phone number. And Dane, do you charge, if somebody wants to call you, ask you a few questions, is that consultation cost money?
Absolutely not. I'm happy to help whoever I can and help them figure out what it is they need, and then go to work from there with them.
Fantastic. Great. Well, if you have questions for me, this is my email address, and you can reach me at the 877 number, our toll-free number. You can also find out more about Advocate Capital at our website, and you can see more of our webinars on our YouTube channel. We do have a monthly webinar each month designed to help plaintiff lawyers get even better results for their clients. That's what we're about here at Advocate. Dane, anything else?
No, that's about it. Hopefully, we'll see some good basketball games tonight, and then the basketball fans out there. My bracket is toast. I don't know about you guys. I was going to
say, it's a weird year, man. There are going to be some real underdogs making money this year because all the smart money is dead already.
That's right. That's absolutely right.
Fantastic. Thanks again for being here, for all your time today, Dane. And I'm sure we'll be talking again soon.
Okay. Thank you, Mike.
And thanks to our viewers for joining us today. Have a great day.